Hello everyone, this is Keerthana, Assistant Professor, Department of Commerce. Today I am here to present a lecture series on the subject Financial Management on the topic Factors Determining Capital Structure. So first we can see what is capital structure. Capital structure refers to the combination of debt and equity that a company uses to finance its operations and growth. It represents the proportion of various funding sources including equity capital like shareholder investment and retained earnings and debt capital such as loan, bond. So some companies also use hybrid instruments like convertible debentures. An optimal capital structure balances risk and return, aiming to minimize the cost of capital while maximizing shareholder value. The choice of capital structure depends on factors like industry norms, business risk and financial strategy. So actually capital structure it is then combination of both debt and equity which helps the company to finance its operations and growth. It also includes equity capital and debt capital. So in equity capital we have shareholder investment and retained earnings, and in debt capital we have loan and bond. So some companies use hybrid instruments like convertible debentures. An optimal capital structure, risk and return, aiming to minimize the cost of capital while maximizing the shareholders' value. So next we can see the factors determining capital structure. So the capital structure of a company is influenced by various internal and external factors. So these factors help determine the right mix of debt and equity to ensure financial stability, minimize risk and maximize profitability. The key factors in affecting capital structure are: first one is nature and size of the business, and second one is cost of capital. Next, financial risk and leverage, profitability and earning stability. Next is control considerations and market conditions. And in flexibility in capital structure, tax benefit, industry standard and competitor strategies, legal and regulatory environment, availability of fund, growth and expansion plans. So first factor is nature and size of the business. So large and estimated business with stable revenues can take on more debt, while smaller or new business rely on equity. So cost of capital. Companies prefer financing operations with low cost. Since debt is usually cheaper due to tax benefits, firms may use more debt if the cost advantages is significant. In finance risk and leverage, high debt increases financial risk due to fixed interest obligations. Companies must balance leverage to avoid financial distress. Next is profitability and earning stability. So firms with stable and high earnings can manage debt better, while companies with fluctuating profits may prefer equity financing. So control consideration is issuing more equity may dilute ownership and decision making power, whereas debt allows existing owners to retain control. Market conditions. In favorable market conditions, companies may raise equity easily, while in uncertain times they might rely more on or debt retained earnings. Next is flexibility in capital structure. Companies prefer a flexible capital structure that allows easy adjustments in financing based on changing business needs. So in tax benefits, interest on debt is tax deductible, making debt financing attractive. However, excessive debt increases financial risk. Industry standard and competitor strategies. So in this, firms often align their capital structure with industry norms to stay competitive and maintain investor confidence. So legal and regulatory environment. Government regulations and corporate laws influence the extent of debt and equity a company can use. Availability of funds. Companies choose financing sources based on the availability of capital in the market, considering investor and sentiment and lending policies. Next is growth and expansion plans. So business with aggressive growth plans may use more debt due to fund expansion, whereas stable firms may prefer equity or retained earnings. So first we have seen the capital structure meaning, and next we have seen the factors determining capital structure. So first one is nature and size of the business. So based on the large established business with stable revenues, which is more debt, or smaller or new business may earn equity. Next is cost of capital. So the cost, financing options with lower cost since debt is usually cheaper due to tax benefits. Next is financial risk and leverage. Due to high debt increases financial risk, it interest obligations. So profit and earning stability, fluctuating with profits may prefer equity financing. So control considerations includes more equity while it may dilute the ownership or decision making power. So next is market conditions. So if it is in favorable market condition, company may raise equity easily while in uncertain times. So next is flexibility in capital structure. So based on the easy adjustments in financing, charging the business needs. So next is tax benefit. So interest on debt is a tax deductible, making debt financing attractive. So industry and standard or competitor strategies, it helps to maintain competitive and investor confidence. Next is legal and regulatory environment. It also helps to extend debt and equity on a company can use. Availability of funds. So checking the availability of funds may help to maintain the risk strategies. Next is growth and expansion. So if business with aggressive growth plans may use more debt to fund expansion, whereas stable firms may prefer equity or retained earnings. Hope the video was useful. Thank you.